Hello everyone, and welcome to the latest in BDO series of international tax webinars. Today's webinar focuses on tax compliance traps for businesses that are expanding internationally. My name is Malcolm Joy. I'm an international tax partner in BDO's London office in the UK. Delighted to be joined today by four colleagues from around the world. Jerry Ciardi is an international tax principal in our Houston office in the US. Jigar Sayer is an international tax partner in our Mumbai office in India. Jesse Yang is an international tax director with BDO in China. And Richard Wiseman is a director in our global outsourcing team based here in the UK. Jerry is going to lead the discussion today, and we'll look at international expansion from the point of view of the head office of the multinational. Jerry's presentation uses a US multinational as an example, but many of the issues he will be raising apply generically to all international businesses wherever they're based. Jigar and Jesse will then talk about specific issues related to expansion into India and China, and then Richard will look at different ways of managing tax compliance across a range of countries. For those of you who require certificates of attendance for CPE purposes, there will be a series of pop-up questions throughout the webinar, and you'll need to respond to at least 3/4 of the questions to be eligible for a certificate. We would, however, encourage all of you to respond to the pop-up questions whether you need the certificates or not, as they will form part of a survey that we're carrying out on international tax compliance. If you do have any questions, then please submit them using the Q&A box in the right-hand corner of the screen, and please select all participants when you submit your questions. We'll aim to have some time at the end of the seminar to respond to some of those questions. Primary means for broadcasting the sound on the webinar today is via your laptops, but we are aware that particularly if your bandwidth starts running low, then the sound quality can be impaired. And if you do have any difficulties with the audio broadcasts, you can click on the telephone icon on the participant panel to the right of your screen, and this will give you teleconference details. Links to a recording of the presentation will be sent out to all those who registered a couple of days after the event, and this will include a link to a download of the slides. And with that, I'll now hand over to Jerry.
Thank you, Malcolm. Our agenda for today includes topics on setting the stage or traps on entry into a country, matters to consider when funding the growth of a particular multinational, tax filing traps, a look at how multinational will monetize its investments in repatriation and exit matters, and then closing remarks. And so if we could move to the next slide and then the following one after that. So next slide, Pete. Yep, there we go. So as Malcolm indicated, to guide us through the presentation, we raised a hypothetical where we use a U.S. multinational company that intends to grow or is growing in certain markets. The two markets we chose for today's presentation are China and India. We chose these markets because of their importance in global trade, the size of the market, and the sophisticated tax system that each of the countries has. As you will see, we start with the company entering into China, perhaps are just testing the market, and we'll need to decide whether they do a direct or an indirect investment into that market. Perhaps the company will make a strategic acquisition, in which case it may need to form a local country vehicle to acquire a target or maybe register an existing company. In my experience, it is critical to think about how the new venture will be funded. So we'll have a lot of discussion about the differences between debt and equity and the mix of debt and equity. How soon will it be profitable and how we would repatriate cash. We will then move into a couple different stages where we either operate, reinvest cash, or repatriate cash. And I think the point here is during these stages we need to look at assumptions that we made into entering a particular country to make sure the company is still operating as intended in a tax-efficient manner. And then finally, we would move to exit strategies. And if we can move to the next slide. This slide shows some basic structures and addresses what is potentially the first question we get asked by clients, and that's, do we enter a country as a branch, as a separate legal entity, or as a holding company? In my experience, there is no best practice structure that is used. There are structures that may be used to meet specific needs or objectives, and then there's inappropriate structures that should not be used. A good example is a tax-haven holding company that lends funds to a Mexican subsidiary. In my opinion, that's not a good structure to use based on the changes that Mexico just introduced in 2014. And with that, I think Jigar had some thoughts on India and some of these concepts.
Yes, thanks, Jerry. In fact, holding company structures are being globally questioned under the BEPS situation. However, investment in India still flows in from maximum investment flows from Mauritius and Singapore, and that's primarily due to PT benefits that is available on exit. So a lot of companies in India do prefer routing their investment through a holdco situated in either Mauritius or Singapore. With that, we move to the next slide, where I think Jesse can discuss the legal structures on entries in China.
Thank you. From China perspective, when you make direct investment to China, the major forms of the investment would be a wholly foreign-owned enterprise, i.e. UVI, or a representative office, the rep office. Actually, there is no legal form that is called branch in China except for some financial institutions. And usually, the rep office will be the most entry-level way to make direct foreign investment into China by the foreign companies.
Yeah, Jesse touched base on the China rep office, and if we can go back to slide 7, I want to address the legal entity types. Under the U.S. check-the-box rules, there are certain legal entities that we can choose a tax classification. So we could choose the entity to be either a taxable entity or a flow-through entity. These are known as eligible entities, and there are some entities where we cannot choose a tax classification, and these are sometimes referred to as per se entities. I am amazed how often we see the wrong entity being used, perhaps because people just don't consider the tax applications, or a lot of times it's because we have a client that maybe is doing an acquisition and the U.S. tax regime was never considered, but using the correct legal entity is something that is very important. In addition, certain income tax treaty provisions, in particular the limitation on benefit provisions, can be influenced by the legal entity type that we use. So it is critical to understand the legal entity types that people use throughout the world.
Yes, I think Jerry, when you mentioned limitation of benefit, it is very important even when investing in India perspective because of the substance tests in India. Although the Indian law does not prescribe any substance test, but yes, there are judicial precedents which prescribe that any entry or any structure needs to have substance and not just form. In fact, India has already enshrined an anti-avoidance law in its tax law, which, however, has been deferred and currently is proposed to be coming into effect from April 16. So in India, treaty shopping the revenue has come down heavily on treaty shopping, and India is one of the key countries which has looked at treaty shopping in a very strict manner. Going on to the next slide, Jesse will take over and explain more about legal entities in China.
Yeah, as discussed just now, the two major forms for investment into China is the UVI and the rep office. The major difference of the two is that a UVI is an entity incorporated in China legally, and which will be regarded as Chinese tax residents usually. While the ULV is not, the ULV instead will be considered as a fixed place permanent establishment in China, where the RO will indeed have its own set of tax compliance requirements to be fulfilled with. We can move to the next slide to see the key considerations for the two investment forms. First of all, the setup process for RO and the ULV will be different. In particular, more approval authorities will be involved for setting up a ULV in China. Hence, the processing time for setting up the ULV will be comparatively longer than the RO. And secondly, the business of there is no registered capital requirement for ROs. While for ULV, under the new company law, actually there is also no statutory registered capital requirement. However, for some industries and some districts in China, in practice, the approval authority will still require some minimum registered capital before approving the business license for the ULV. And very importantly, you should know that ULVs are not allowed to conduct revenue-generating activities in China. Hence, an ULV actually cannot issue any official invoice or own any special license, such as import and export license. On the other hand, ULVs actually can carry out any activities it wants to do, unless the industry is restricted for foreign investors. For example, education or advertising, some in special industries. Last but not the least, generally operation costs for the rep office will be lower than the ULV because usually the ULV will have a larger scale in terms of the person, the staff number, and office space needed for operation. And we can move on to the next slide to see the other considerations. Tax will be one of the key considerations, of course. Actually, the ULV in practice, they have a very good position to apply tax or financial incentives from the Chinese local governments because the government will prefer a ULV than an RO because the ULV have a larger capital investment and a foreseeable more tax contribution to the local bureau. The other consideration is that actually the tax loss for the ULV could be carried forward for consecutive 5 years, while there is no tax loss carry forward mechanism for rep office. The ULV could use their profits to do free reinvestment in China, well, this is not available for rep office either. Last but not least, when the ULV would like to repatriate profits, there will be a withholding tax clearance required, for example, for dividend repatriation. But this is not required for the rep office generally. Then we will see what's happening in India.
Thanks, Jessie. So Indian exchange control regulations is what govern foreign investment in India, and India has slightly more number of choices in terms of entry, depending on what nature of business that you're going to do in India. So India permits foreign investment in India in forms of having a license office, which is permitted only to do limited licensing activity, or a branch or a project office, which is of a temporary existence. Limited liability partnerships are a new concept in India, and foreign direct investment has recently been opened into limited liability partnerships. However, this require approval. Joint venture and wholly owned subsidiary are more corporate entities and are more regularly used by foreign investors in India. In the next slide, we look at a comparison of all the various types of entity. Importantly, the ones which require approval are license office, branch office or project office, and limited liability partnership. So they take slightly long time to set up, whereas a JV or a wholly owned subsidiary normally does not require a prior approval, except for in certain restricted sectors, and it could fairly be set up in a fairly short time. And very recently, the Government of India has also introduced a scheme of single window clearance, where on a single portal, a company can be registered and all registrations can be obtained, and the company could be formed as quickly as 10 days. When you look at operations, the liaison office is a restricted entity. It is not required or not allowed to do commercial activity. It's only allowed to do licensing activity. A branch or a project office also are restricted in terms of what approvals they obtain, whereas again a wholly owned subsidiary, normally their activities are not restricted unless the activity is generally prohibited in India. Cost-wise, liaison office, since the activities are low, could be lower, and as a wholly owned subsidiary has more compliances to complete, the cost could primarily be high. Normally, limitation in branch or project office is that while granting approval, the central agency looks at the track record of parent, which should be minimum 3 to 5 years, and a net worth of $100,000. Whereas in wholly owned subsidiary, this is not the criteria at all. In the next slide, where we look at comparability in terms of tax, where we say liaison office is really not taxable, and branch office or a project office is treated as a non-resident and is subject to a tax rate of 40%, whereas the limited liability partnership and wholly owned subsidiary are taxed at the rate of residence, which is at the rate of 30%. These rates generally go up by about 10% of these rates, so about 3 to 4% depending on the income levels. In a liaison office, since there are no profits, there are no questions of allowing losses which could be carried forward. And same is the case with a branch office and LLP. Here they are allowed to be carried forward. In terms of profit repatriation, liaison office, branch office, are basically foreign entities, and they are not treated as legally separate from the parent, and hence there is no requirement of any taxes payment on repatriation, whereas a wholly owned subsidiary or JV is treated as an independent entity, and there is a requirement of paying a 20% dividend distribution tax by the company before it distributes dividends. On winding up, a liaison office and branch office are simpler, and winding up of LLP and wholly owned subsidiaries are slightly more complicated. It's interesting to see that what a choice of entity can do for you. For example, there was a client who had come to us saying that they wanted to set up a subsidiary in India, and the activities they were really looking at was procurement. When we understood their activities and explained to them what they really need to do, on conclusion we advised them that they could look at setting up a liaison office in India, which could result into no taxes payment in India and no profit parking in India. The remittance can come from the parent, and exit could be easier. So they ultimately choose to go for a liaison office in place of the originally planned wholly owned subsidiary. So yes, it's important to understand what is the nature of entity that you want to set up in India. Over to you, Jerry, to discuss the funding on the next slide.
Yeah, thank you, Jigar. Yeah, we'll now move to the funding section of the webinar, and although we'll address some repatriation issues later on as well, my belief in discussing how a company gets funded is really a discussion of how we want to repatriate or redeploy cash in future years. So I think they're kind of tied, one concept with the other. And although we are focusing on China and India, there are many countries that have strict requirements relating to funding. A very good example is Brazil. So with that, I'll ask Jesse to first address some of the China matters, and we can go to the next slide.
Thank you, Jerry. For funding in China, it's very important to understand because China is a foreign exchange control country. So every capital injection, cross-border trade, and service transactions settled in foreign exchange, overseas financing, and profit repatriation of the foreign investment are subject to exchange control regulation. For example, if the foreign investor wants to inject a loan to the Chinese subsidiary, the foreign loan has to be registered with the approval from the State Administration of Foreign Exchange, i.e. SAFE. And every repayment of the loan has also to be deregistered with the local branch of the SAFE. On the other hand, if the foreign investor wants to increase the registered capital of the Chinese subsidiary, the process will actually be more complicated. The Chinese entity needs to obtain different approvals from the local Commission of Commerce, register with the local Administration of Industry and Commerce, and also some other local authorities. Also, it's worth noting that based on Chinese company law, the entities in China should take out 10% of its net profit as the cash reserve until the company's net profit, the accumulated amount of cash reserves has already reached 50% of its registered capital. From a tax consideration point of view, in light of the tax clearance procedure for remittance of non-trade items, for example, as mentioned before, the dividend interest from Chinese company to the overseas investors, there will be potential withholding tax payment to be settled during the process of tax clearance. These potential withholding tax payments are to be withheld by the Chinese payers, and that tax payment will need to be settled with the Chinese in-charge tax authorities on behalf of the overseas parent companies before the remittance. Interest can be deductible if it meets thin capitalization rules, which we will explain in the next slide. Next slide, please. Here we are. In China, the thin capitalization rule sets out that if the Chinese entity's debt-to-equity ratio exceeds 2.2 to 1, the excess portion of the interest expense actually on the related party loans are non-deductible unless the interest rate can be demonstrated to be met with the arm's length principle. The Chinese tax authority would have their own set of rules to review whether the interest rate is within the arm's length rules, because they will refer the rate set out by the China Central Bank. So this is the basic thin capitalization rules in China. And we now can move to India.
Thank you, Jessie. In India, as similar to China, there are certain considerations one needs to get it right to be rightly funded. And as Jerry also explained, it's a key to get the funding right to have not cash sit back in the country and have a smooth repatriation. India permits various forms of instruments, but ranging equity to hybrid instruments and then to debt. While unlike China, India does not have thin cap regulation, but funding in terms of loans, which is termed as external commercial borrowing, has restrictions around in terms of who can the eligible borrower be, who can the lender be. There is a cap on the interest rate. There is a minimum funding period which is to be used, and there are reduced restrictions that you can't use the loan for funding the working capital requirements, whereas equity is fairly free to use, limited restrictions. In fact, in terms of withholding on remuneration to equity, yes, equity does suffer a dividend distribution tax, which is to be paid by the company declaring the dividend. As against this, interest in case of the external commercial borrowings is fully deductible provided certain conditions are met. Jerry, probably you want to throw some light on thin cap CFC or anything in the USA?
Yeah, thanks, Jigger. And, it's nice to hear, there's certain conditions that are imposed in China and in India. I guess from a U.S. tax point of view, we need to do our own analysis to determine what is debt, what is equity. It is very much a substance-driven determination. And although the registration requirements that Jesse talked about or documentation requirements, local country treatment will be factors that are considered, they will not drive the outcome of how we define some instrument as debt or equity. I guess from my experience, I see companies that need to fund their investment in tranches. This needs to be considered up front. As Jigger indicated, if a company does not do this, they could find that their cash is trapped in the local country. And so please keep in mind, especially as Jesse talked about with the registration requirements, if you're going to do things in tranches or in multiple phases, keep in mind the registration requirements. Jesse and Jigger spoke about the thin capitalization rules. With our multinational corporation that we're kind of using as our example, we need to consider how GAAP to maybe IFRS to local country definitional differences may affect the definition of an instrument as debt or equity. And depending on how something is defined, that could definitely alter the debt to equity ratio. I think another concern that Jesse and Jigger addressed, but I would like to highlight, is how interest expense might be non-deductible, but you still have to be still have to consider whether the interest is subject to withholding tax. And so there's a potential whipsaw in being having something that's non-deductible but still subject to withholding tax. And then finally, maybe tying the funding discussion with the legal entity structure discussion. Again, through the use of the U.S. check-the-box rules, we could set up a structure where the intercompany balances are ignored for U.S. tax purposes. This means, again, for U.S. tax purposes, we could plan around some of our anti-deferral rules and some of the tax traps that might, that might arise if we don't use the check-the-box rules. And with that, if we can move to the next slide to talk about tax filings, and I will actually move to the next slide and have Richard tell us a little bit about the compliance process.
Sure, thank you. So my name is Richard Wiseman. I work with Global Outsourcing at BDO, and I think it's great that so far we've had a bit of an introduction from Jigger and from Jesse of the complexities of setup and funding in India and China. And obviously once you've gone through those stages, focus then turns to how you manage your new compliance burden. And we will use the remainder of this section to give you an insight into the complexities of India and China. But initially, I'll use the next few slides just to give you an overview of the challenges that I see my clients and some of my contacts facing in this particular area. So what is compliance burden? Well, compliance burden is understanding how you do business in your new jurisdiction. It's also building your understanding of the accounting rules and regulations and the tax environment on the ground. It can also focus on things such as document retention regulations and how you address your trade license requirements in country as well. So what I've got on this slide is just some of the key questions, some of the 5 questions in fact that have been put to me in recent months by new clients and existing clients. And what I'll do just briefly is look at some of the root cause of compliance gaps, and then move on to understand some of the tax team challenges that exist with managing your new compliance burden as you grow into new territories. So what are the root causes of some of the compliance gaps? Some of the questions there. Have we filed in Zimbabwe? Will my corporate books satisfy local requirements? These are common questions that are put to us, and quite simply the root cause of these questions is simply a lack of understanding of the requirements in country. And that's understandable. Every country has a level of complexity, and we've made reference to India and China. Brazil in particular, and some of my European colleagues will say that there are some challenges in their respective countries as well. There can often be insufficient governance and control around how you are maintaining a sound compliance overview of all of your entities across the globe. As your multinational company develops and grows in size, that will become more and more challenging. There's also perhaps a lack of focus or resource available to understand and manage these new compliance needs. And that's when you then need to consider what your compliance model looks like and what potential external input you require to satisfy those local obligations. And furthermore, one of the challenges we see with our existing clients is how you ensure that your organization has the data available to you to satisfy these requirements. There is an increasing level of scrutiny across different tax jurisdictions that requires a complex level of accounting data, and you need to ensure that your organization is capturing that data to satisfy all these requirements. One of the examples on the screen there is why is my entity being struck off in Denmark? In some countries, if you get compliance wrong, your entity could be struck off. In other countries, you can receive a very polite letter from the authorities advising of a small penalty or fine. In some countries, you can be threatened, your directors can be threatened with imprisonment. So compliance has to be right first time. On that basis, compliance is often regarded as a hygiene factor, and it is a factor that is being managed and coordinated by global tax functions for every entity. But the change has shifted. What I have seen over the last 8 to 10 years is a shift of the tax function from a national focus, where they are handling local compliance, tax accounting, and local authority liaison matters, to a shift where they are having to understand multinational country requirements, often in developing countries, which requires a new expertise, new resource, and new platforms to satisfy these requirements. The pressure can often be on maturing accounting systems, as I said earlier, to ensure that you have sufficient data to manage the tax compliance processes. What can often take a back seat, and what, as a service provider, we are being asked to assist with, is tax planning and strategy matters, because these are often matters that are left to the final part of development, and because so much time is being taken by compliance matters, they're just not given the appropriate time in country. So what are some of the tax team challenges? Just to draw out two, the changing tax requirements globally. It's not uncommon for sales tax, VAT, GST rates to change on a periodic basis, and you need to ensure that your underlying platforms are being updated to incorporate those. There are other examples of more cross-border scrutiny under the BEPS regime, and that's something that needs further consideration moving forwards. There's also emphasis, certainly in the countries such as Brazil, Mexico, France, where electronic data is being brought to the forefront of the tax authorities' toolkit, and they are effectively using electronic audits to understand and analyze your data. So we need to be prepared in the future for, again, having available data at the time that it's requested. Finally, one of the points here that I think is worth drawing out is the management and maintenance of a strong governance. Inadequate organizational governance, certainly within a tax organization, can lead to insufficient and ineffective tax compliance and reporting processes. And what we find is that organizations that have constantly established a process where the tax team are constantly involved in understanding business strategy and understanding reporting lines, the processes are often improved and the compliance matters become much more easier and less of a burden. But what is then the right model for managing global compliance? Well, there are 3 examples on the screen here. Firstly, one with 2 variants, and then number 2, that's of a local outsourcing model, and number 3 of a centralized outsourcing model. The timing and the use of these models is really dependent upon your business stage of growth, and also with the view in mind of balancing people, processes, and platforms. The adequate level of people are required to ensure that you can manage these processes in country efficiently, and you need sufficient platforms in place to ensure that you have the information readily available where required. Technology is therefore an enabler and can often support the growth and also force you into one of the appropriate compliance models detailed. And technology as an enabler for compliance matters could be used in one of 3 ways. Compliance coordination is absolutely key, and technology is often used by organisations to manage their compliance processes in country. So that can be your local statutory deadlines, to the roles and responsibilities of individuals to deliver that process. Technology is also used for tax provisioning, tax determination, and tax reporting. And it's important that the right level of investment is made at the right stage in your growth to ensure that these areas are adequately covered to help you manage your compliance burden. Looking at the compliance models, the first model to look at is the in-house in-country. That is a model that's used primarily in the very early stages of an MNC growth. It is where you have local finance and tax professionals on the ground in country, and those professionals are responsible for managing and coordinating the local obligations. A slight variant of that is a country cluster, whereby perhaps your finance manager or tax manager in Germany can focus on Germany, Austria, and Switzerland, for example. And that is very commonly used in the early stages of development, and we often work with our clients initially where they have such model. As the level of complexity develops and as those individuals need to be more focused on business matters, it is not uncommon for a local outsourcing model to be deployed. And that is where those finance and tax individuals have the authority to effectively outsource some of the compliance obligations to external parties. And those external parties, such as BDO, would be able to support the respective entities with direct tax, indirect tax matters, as well as other compliance issues that come to light. Again, as an MNC then further matures, or perhaps you develop perhaps a shared service type organisation, it is not uncommon for a centralised outsourced model to be deployed. What we mean by that is whereby one partner is effectively selected and coordinates the global compliance framework for the multinational clients using local in-country providers. And that effectively gives you the benefit of a centralised coordinated model, but with the advantage of local experts on the ground in-country that can continue to support your in-country needs. There is often lesser of a requirement then for tax managers and finance teams to have a compliance focus in-country. It's coordinated and centralised at the very heart of the business. Moving on to the next slide, I'll then talk a little bit more about centralised outsourcing, because this is very much the BDO model, and it's the model that we have worked on with a number of clients that we believe really brings a client a standardised process, standardised reporting, and visibility and transparency of their global compliance window. It's absolutely essential, and one of the things that we hear from potential clients, they do not have visibility of their on-the-ground compliance matters. And what we bring, and what a centralised model brings, is that visibility in one single forum, one single location, that then enables you to manage and lead your business moving forward. It also then goes back to the original slide where we said there was insufficient time and focus being placed on tax strategy. That focus can then be reignited within the business, leaving the compliance matters to an external provider. Now, given that as a very brief overview, it would be useful now for Jigar to give an insight into what tax compliance looks like on the ground in India. Jigar, are you still with us, sir?
Yes. So India is something where we deal with multiple tax authorities on direct tax front, on indirect tax front, and yes, tax filings, as Richard mentioned, need to be coordinated and controlled well so far as India goes. The financial year in India is fairly April to March, and that's something which even the company law requires everybody to follow. The only thing is that for certain countries on approval, you can seek a different financial year, provided your parent follows a different year, and tax year is uniform for everyone. One of the questions which I get most of the times is do I need a PAN in India? Everybody's asking me to get a PAN. Do I need a PAN in India? So PAN is nothing but a tax identification number in India, and a lot of myth around PAN that if I have a PAN in India, I might create a permanent establishment, but that's not really true. PAN by itself does not trigger a P or create any tax obligation in India. In fact, PAN does help you to reduce the withholding on certain payments from India to those countries. On the next slide, where we look at the corporate tax filings in India, where corporate tax rate in India is 30%, as I mentioned earlier, and it is proposed that this would go down to 25% over a period of next 4 years. In India, currently there is no regime where an extension is permitted for filing tax returns, and filing tax return in time is really important. In absence of that, you may lose the carry forward of losses. So yes, and of course, you need to file the tax return carefully, because there is penalty which could range from 100% to 300% in case of non-disclosure or incorrect disclosure. In the next slide, where we discuss the key aspect in Indian tax is transfer pricing, and Indian transfer pricing is globally known for the issues that they have brought to fore, and even OECD in its BEPS program has taken notice of the challenges that companies face in India, and how transfer pricing is being used by corporates to plan or shift their profits. Indian transfer pricing has extensive coverage. There are certain transactions including transfer of shares, excessive brand promotion expenses, overdue receivables. Even these are subjected to transfer pricing in India. And even certain relationships with unrelated enterprise, like for example licensing, are at times covered by transfer pricing. Interestingly, transfer pricing, it's very recent. It was introduced only in 2001-2, and till now we've had 10 rounds of audit which are completed, and almost $45 billion of adjustments have been made by the Indian revenue authorities on account of transfer pricing. With so much of adjustments happening, the Indian law has also recently introduced some tax certainty measures like safe harbors and APA. The key point that I would like to drive here is when you're structuring a business in India, transfer pricing is a key consideration, failing which either you would end up parking cash in India, or for insufficient profits, you may end up into transfer pricing litigation. Moving on to the next slide, where key thing that I wanted to highlight over here is the withholding tax. So, like Richard also mentioned, a lot of countries have moved to electronic monitoring systems. India has also moved to electronic monitoring systems where everything is required to be filed electronically, including when an Indian company makes payment, it is required to withhold taxes and report it electronically. And while the recipient of these payments files his tax return, he has to give the details on an electronic return, and these are then matched. And when they're not matched, there are two challenges. Either there is a challenge of denial of credit for withholding tax, or there could be a challenge where some income which is not reported is brought to highlight. Moving on to the next slide, where I've highlighted certain indirect tax filings. India is a country with multiple indirect tax laws. There are more than 18 indirect tax laws, a different law for imports, a different law for manufacture, different on sale, different on services, local levies, entertainment taxes, multiple things. And some of these laws or these taxes are not creditable against each other. But we are changing, and the government is on its way to introduce a GST law where it will subsume most of the indirect tax laws except for customs, and they will then become creditable against each other. So currently it is being debated in the Indian Parliament, and we should see the light of the law soon. With introduction of GST, each of the multinational present in India would need to relook at their entire operations in terms of the supply chain planning, the pricing, the IT infrastructure, training of people, and this is where BDO can really help in companies in setting the tone right at the beginning. While there are some other statutory and regulatory filings, but those are something which are fairly standard across most of the jurisdictions. With this, I hand over to Jesse to take us through what are the compliances in China.
Thank you, Jigar. Now we will move on to the tax compliance for China. Actually, for doing business in China, there will be different stages, as shown in the table in this slide, which may give you an overview of the flow. Actually, in each stage of the flow, there will be different compliance considerations, from the site selection, registration, to the end of the life cycle of the Chinese entity liquidation. For example, when the company is going to be registered in China, the registration process for setting up a company in China will be relatively more complex than that is in some of the other countries, because there will be many different approval authorities involved. Even if the company is going to be liquidated at the end of its life cycle, there are same number of the authorities involved where the company should obtain approvals from before the company could be officially closed. In the stages as shown in this table, the most commonly discussed aspect is actually the recurring tax filing, because there are just too many types of tax involved in China, and there are different frequencies of tax filings required under the Chinese tax rules, which makes the whole thing looks like very complicated than the other countries. For example, there will be quarterly and annual income tax filings, while the value-added tax and business tax and also the individual income tax will need to be filed on a monthly basis. The most challenging thing is that the local practice in China for the recurring tax filings could be different in different locations. Like in some of the locations in China, these filings could all be done in an online system, while in some districts in China, some of the filings could only be performed manually and need to be submitted to the in-charge tax officer in hand. So given the complication in China of the tax practice, we will suggest the companies doing business in China shall have some professional staff or agencies to handle the tax compliance, because if the tax filings are performed not within the timeline required by the tax law, or the figures submitted are not accurately submitted on an accurate manner, there could be late payment surcharge or even penalties. Then we will move to the next slide to look at some commonly seen pitfalls in China. As mentioned before, because China, there are tax rules, but in practice, there are just too many discretional practice in different locations in China. I just list some of the major pitfalls here. For example, the foreign exchange control, as I mentioned before, a lot of the cross-border transactions will need to be governed under the foreign exchange rules. I would like to, in particular, address the management fee issue, because this might be different from the other countries. Management fee, if it is paid in a stewardship nature, and it is not deductible from Chinese corporate income tax purpose, because only service fee is deductible. The difference between management fee and service fee is that the Chinese Tax Bureau would view service fee as a fee paid for carrying out actual service activities, which brings direct benefits to the Chinese companies. While management fee is actually paid more in a stewardship nature, and it should be paid to the overseas parent company in the form of dividend, which is not deductible before before the income tax calculation. The other hot topics right now is the commercial substance for indirect transfer of the Chinese company. This means if the company, if the foreign home country entity is holding the Chinese entity through an intermediary holding company, for example, in Hong Kong or BVI, if the home country entity disposed the shares in the intermediary holding company, while the intermediary holding company does not have sufficient substance, for example, they do not have enough staff or assets, such transaction may be regarded by the Chinese Tax Bureau as a direct disposal of the Chinese company's shares. And if that's the case, any gain derived from this transaction might be viewed as subject to the Chinese corporate income tax. Of course, there are a set of requirements and criterion for the Chinese Tax Bureau to view whether the intermediary holding company has substance or not. But we will still want to remind the foreign investor, and in such case, you should carefully review the case before the transaction to avoid any underpayment of Chinese tax or even the reporting obligation, because both of them will trigger penalties in China. Then we can move to the next slide to see what we could do to make the tax compliance in China more smoothly. And first of all, based on our experience, when we are involved as professional, because China is just so large, so when we handle compliance work, we found that effective communication with clients will be very important to make sure all the information we obtain is accurate. Especially, this is especially important when the tax compliance has involved different locations in China, for example, branches in different locations with the head office in one city. Secondly, we also found that a reliable quality control process would be very important. Only with it, one could ensure all the technical tax treatments adopted are compliant to the most updated Chinese tax regulations. Because as you can mention, and you can notice from the previous pitfalls, because there are just too many tax updates and changing legislation environment in China. So that one should keep updated with the most new tax rules, so that every tax filing could be done compliant with the law. And moving to the next slide, we can see the skillful communication with the Chinese tax authority could also be very important. This is quite a Chinese feature thing because given the discretionary environment in China nowadays, in practice, good networking actually can help a lot to ensure the communication channel with the right authority or the right person is good. Without it, a lot of the controversy cases could not be settled in a very effective way. Last but not least, we would also to remind that a robust business process is very important to avoid the tax compliance risk in China. We will recommend the company should get professional advice to review its internal control policies from time to time and to improve any deficiencies, so that any tax risk could be identified before the risk is crystallized. Okay, then we will move to the next section to talk about repatriation and exit.
Yeah, thanks, Jesse. And one point to make, Jigger talked about the large penalties for non-disclosure and incorrect disclosure in India. I think through BEPS, we'll probably see a lot more countries introducing that type of legislation. As a matter of fact, Brazil just introduced a provisional measure. So it's not law yet, but it's a provisional measure where they're saying that if people conduct particular tax planning that you would have to disclose it or potentially be subject to some penalties or losses of tax attributes. And so it'll be interesting to see what Brazil does in the rest of the world. And with that, if we could maybe go back to Jigar and talk about some repatriation exit issues.
Thanks, Jerry. Interestingly, India is a large market, and every company wants to enter India to make profits. And the question then comes is, how do we repatriate profits? And once we have the right value, how do we exit? So it's important right in the beginning on how you structure your entry. This will help you, easy repatriation and also most efficient exit. So common forms of repatriation are dividends, which are of course subject to dividend distribution tax of 20% of the amount which is distributed. So that really makes it not so efficient. But the common forms of payment of interest, royalties, management fees are largely used, and if they're rightly justified for the Indian transfer pricing. Even buyback is permissible, but it's subject to tax withholding in India. Exit on sale of shares, capital gains is dependent on the period of holding. Anything where you've held for a period of more than 3 years would be treated as a long-term and hence be subjected to a lower rate of tax. Certain tax treaties provide beneficial tax treatment, like as I mentioned initially, Singapore and Mauritius. So if a Mauritian company sells its shares in the Indian company, the treaty provides that it would be taxed in Mauritius, and we all know that Mauritius does not levy tax on capital gains. So that's how treaties are used to structure investments, but it is very important to have substance around these treaties, these investments. And very recently, India has been in news for introducing a law which is basically on indirect transfers. So, for example, there is a holding company or intermediate holding company. There is a UK investor who has a company in the Netherlands, which in turn has a subsidiary in India. So if the UK company exits the Netherlands company, so there is no event occurring in India. However, this could be subjected to tax in India if the value of the Netherlands company is substantially determined from the assets situated in India. So this is something which Vodafone was enshrined into a huge tax litigation, and later on Vodafone did win the tax litigation. However, the government went back and made retrospective amendment to the tax law. So this is something which one would need to watch out for. Interestingly, we were working with BDO UK to advise a client on how to get certainty, and there is an authority for advance ruling which you could approach to gain more certainty in these types of transactions. That's from India, and I'll hand over to Jesse to talk more of repatriation from China.
Thank you, Jigar. Actually, I have talked many of the major points for taking money out of China, and you can see that tax is almost unavoidable during the tax clearance process. So overall, I would like to address that based on our experience, foreign companies should seek professional advice to have a clear picture of the Chinese tax obligation as well as the potential opportunities, so as to minimize the potential Chinese tax liabilities and to avoid the potential interest and penalties. There are certainly potential opportunities such as the reduced withholding tax rates under different tax treaties, but same as India, you should have substance and like beneficial ownership of the payment. Pre-planning would be very important. So I'll finish the repatriation and exit from China perspective, and I'll hand to Jerry.
Yeah, thanks, Jesse. And I guess just we have maybe a minute, a little over a minute to to close here. So 3 quick thoughts. First, as we've seen, I think it's very important for headquarter corporate offices and the local country entities to coordinate their tax functions. Second, I think companies should do periodic tax compliance reviews, what I would call maybe a tax health check, just to make sure as their businesses change and tax laws change, they're kind of meeting their objectives. And third, I think it is critical for companies to communicate effectively both internally and externally, and when possible bring in experts before things become irrecoverable. And with that, maybe I'll turn it over to Malcolm to do a quick closing. I don't know if we have time to address any questions or maybe a summary of the polling questions.
Yeah, thanks, Jerry, and thanks everyone for dialing in. We are a little bit short of time, so I won't go through the specific questions that people have been sending in. I know a number of those have already been answered, and we will get back to you if you have submitted a question. Just a couple of things, just interesting results of the surveys, which hopefully you've seen as we were going through that presentation. So interestingly, the 4 countries that came top in terms of the most giving people the most concern from a tax compliance perspective were the US with 35%, China second with 23%, India third with 13%, and then Brazil with 10%. Biggest area of tax risk overwhelmingly was seen as transfer pricing. 36% of respondents saying that gave them the most concern. Most complex tax regime, unfortunately for the US audience, was seen as the US. 46% of respondents felt the US was the most complex, followed by China on 23%, and then Brazil and India on 11% and Brazil on 9%. And then interestingly, we've had a few questions about inward investment, and one of the questions was, is the UK viewed as a tax haven by other countries? And that linked in with our poll, which is the most attractive regime, and Ireland came top, 19% of respondents saying Ireland was the most attractive, followed by the UK on 16%. And I think one of the things for me about both Ireland and the UK is that in the days of the BEPS initiative from the OECD, when there was a big move to align substance of a business with the profits and the tax paid, what the Irish tax regime offers, as well as the UK tax regime, is that ability to combine a relatively attractive tax regime with a low corporate income tax rate, with the ability to create quite a lot of substance in those countries. So I'll leave it at that on the polling questions, and just finish off with something that links back to that final polling question, which is our next webinar in this series of internationally focused tax webinars. Just a reminder for all of you, that is on Tuesday, the 25th of November, and that will be looking at the next round of announcements from the OECD on base erosion and profit shifting, which are due out in September and October of this year. So look forward to seeing you all on the webinar on the 25th of November.